On this edition of Business Live, Ghana's debt increased by 12.8 billion cedis to 286 billion cedis in November last year. But this is largely due to COVID-19 expenditure. We shall expatiate this for you in our subsequent bulletins. Also, prices of petroleum products expected to go up by over 2% per litre from next week, the second time in a month. Plus, Chartered Insurance Institute of Ghana makes a strong case for the inclusion of health insurance and pensions contributions to the computation of insurance penetration. We have all these stories and more coming up shortly after this break. Hello and welcome, I'm Charles Aite. Ghana's public debt stock shot up by 12.8 billion cedis in October and November last year to hit 286.9 billion cedis in November 2020. That's according to the latest Bank of Ghana's summary of economic and financial data. There is more in this report. The rising debt, which is a worry, represents 74.4% of gross domestic product, that is the total value of goods and services produced in an economy within a period. When this loan is shared among 30 million Ghanaians, each one is likely to pay very substantial amounts. The increased debt was largely driven by COVID-19 spending in a form of stimulus packages to individual households and businesses, particularly small and medium-scale enterprises that suffered significantly from the coronavirus pandemic. The nation may get some relief in the repayment of some of the loans, particularly bilateral and multilateral loans. Many countries, including some advanced economies, had no option but to borrow from the International Monetary Fund and the World Bank to stabilize their economies. According to the data from the Bank of Ghana, the external component of the debt stood at 139.6 billion cedis, whilst the domestic component was, however, estimated at 147.3 billion cedis. On the other hand, the financial sector resolution bond still remained unchanged at 15.4 billion cedis. The International Monetary Fund had earlier forecast a 76.7% of debt to GDP ratio for the country in 2020. Rating agency Fitch also said in December that African countries, including Ghana, that have credit ratings of B and stable outlook will not default in repayment of their loans despite the rising debt levels. Now, prices of petroleum products are expected to witness a marginal increment from next week. This is based on data secured from the bulk distributors of the products and Joy Business's projection. George Raffi has more in this report.
The increment has been influenced by rising prices of finished petroleum products on the international market. This has resulted in cutting production by the oil-producing countries and projection that COVID-19 could soon be contained following the discovery of vaccines. Based on the data secured from industry players in Ghana and Joy Business's projection, a litre of petrol should be increased by at least 2.14% per litre. This should mean that a litre will ramp up to about 5 Ghana cedis, 20 pesos. For those who might be interested in a gallon, well, that should be sold at 23 Ghana cedis, 40 pesos. On the other hand, diesel should also be increased by almost 3% per litre, selling at 5 Ghana cedis, 23 pesos. The development may lead to a gallon also going for 23 Ghana cedis, 53 pesos. Now, these are just averages, and there's the likelihood that it may be more than what we've projected from next week. This is because the last time the prices were adjusted, we projected about 3%. However, when it came to the actual review by the oil firms, it went way above that. This may not be one of those projections because the increase in prices is actually what the bulk oil distribution companies are willing to sell to the oil marketing companies from this weekend. So unless the more than 100 oil marketing companies absorb these new prices, then consumers will definitely be paying more from next week. The expected margin of increase has also crossed the 10% mark set by the Ghana Road Transport Coordinating Council. That should also trigger discussions for transport fares to be increased.
And you may want to stay with Joy Business. We shall give you an update on how things turn out from next week when we assess the situation at the various transport centers. But the Bank of Ghana has begun advanced work towards the establishment of the National Development Bank in the course of the year. The central bank is therefore inviting bids to develop directives and prudential guidelines, among others, for the development of finance institutions. Charles Nixon Yeboah has more.
The Finance Ministry has already received some $200 million from the World Bank towards the cost of the Development Finance Project, which supports the establishment of the Development Bank Ghana. This is under the Development Finance Institutions Bill. The bill received parliamentary approval in August last year and is awaiting presidential assent to ensure that DFIs are efficiently managed with minimal risk of failure. The government decided that the Bank of Ghana should regulate and supervise the DFIs. This decision was informed by the experiences of other countries in which effective regulation and supervision by independent regulatory bodies have contributed to the success of development finance institutions. The objective of the development of directives and prudential guidance by the consultant is to complement the work by the central bank. The consultant is required to consider international standards and best practices as well as mandatory policies and manuals prescribed by the Bank of Ghana. With regard to the business plan for the partial credit guarantee facility, the consultant is to come out with a plan to mitigate risk of lending to certain borrowers and market segments, particularly SMEs and first-time borrowers. Overall, the Development Bank Ghana is expected to provide wholesale loans and guarantees to participating financial institutions for on-lending to micro, small and medium-scale enterprises.
Now, customers of banks are being urged to resort to mobile transactions. This is to ensure that there is minimal human contact to prevent the spread of the coronavirus pandemic. The head of business at CalBank, Ajua, says that her outfit, for instance, has put measures in place to make its digital platforms efficient for use.
COVID-19, social distancing, all of these protocols. Digital is key. So the future in this digital space is about us trying to reduce contacts for our customers. So anything that our customers will normally want to come to the bank branch to perform, we need to ensure that they are able to perform these things by themselves and on their own without necessarily visiting a bank branch. So we will move on that path and deploy solutions that will make it easier for customers. So if you talk about digital part, that is where we are going. And the bank has put in place systems to be able to accommodate all of these things. So we are already set up to roll.
Great. Now talk to me about how secure this particular app is.
Okay, so when it comes to security, looking at the functions the app performs, security is very key. We have the transfers, we have the merchant payments. Without security, it will be more or less like it will be a useless app because we are given an app that is not secure. We have a multi-factor authentication method in place, and when we say multi-factor authentication, we are referring to ways in which users are able to confirm their transactions. So we use what the user knows, and most often when we say what you know, we are referring to your password, your PIN. We have another what you have. When we say what you have, it's something that's only you will have access to. So a token is sent to you for each transaction that you perform. So that's something that you have to confirm. And then we also talk about what you are as a human being, so your biometric features. So this allows you to be the only one who is able to authenticate a transaction. So with all of these in place, you can see that the app is very secured. Yes.
Well, the Chartered Insurance Institute of Ghana is making a strong case for the inclusion of the pension sector and health insurance in the computation of insurance penetration in Ghana. According to the institute, the absence of these sectors makes the insurance sector's contribution to GDP not absolute. The new president of the CIIG, Teria Ben Ahmed, spoke to Joy Business on the insurance penetration rate that currently stands at about just 1%.
First, we've got some, if you like, fragmented regulatory environment in Ghana where the life insurance and general insurance is regulated by the National Insurance Commission. And then you have health insurance, is regulated by the National Health Insurance Authority. And then you have pensions, regulated by the National Pensions Regulatory Authority. Now, let me give you this scenario to appreciate the conversation well. If you have a professional accountant who is a member of a professional accountant body, and he works with a professional body like a professional accounting body like PwC, KPMG, EY, Deloitte, and things like that. It's a professional accountant working with a professional accounting body. That's a professional accountant, right? That same professional accountant working with a bank is still a professional accountant. That same professional accountant working with an insurance company is still a professional accountant. And they are all expected to be part of the professional accounting body, which body then ensures that their professional accounting practices are consistent with their code of ethics and the professional standards that are expected of them. What the Chartered Insurance Institute of Ghana is doing, which is a professional body and not a regulator of insurance-based entities, is seeking to do is to make sure that all individual professional insurers who practice either in the NIC regulated entities or in the NHIA regulated entities or in the MPI regulated entities are brought to be part of the Chartered Insurance Institute of Ghana membership, so that we can contribute to their continuous professional development and be able to have a say in their professional practice. Now, when we do that, then as a professional body, we will then be able to redefine insurance penetration in Ghana. The insurance penetration in Ghana has traditionally been seen as what the National Insurance Commission will come up with, which is made up of only the contribution of life insurance and general insurance. And because of the fragmented regulatory environment, the National Insurance Commission cannot report on the numbers of the health sector because that is under the National Health Insurance Authority. The National Insurance Commission cannot also report on the pension sector numbers because that is also under the MPRA. And by the way, the MPRA has got its own annual report issues. But we as Chartered Insurance Institute of Ghana, and we are the professionals of insurance practicing in these sectors, and some even practicing outside of NIC and outside of NHIA and outside of MPRA, are still professional insurers, and we need to find them and make sure they do things right. But when we now reach out to our colleagues in the health and pension sector, we will then be able to redefine insurance penetration in Ghana and then report on a consolidated view of insurance penetration in Ghana in the CRG annual journal. And what this will mean is that we'll take the NIC numbers and penetration, we'll get the NHIA numbers, and then we'll get the MPRA numbers. The last check, the pension sector had about 25 billion in assets. The NHIA is sitting approximately around 800,000, close to a billion. The NIC is sitting at currently 2019 with 3.5 billion in premiums. Okay, so if you put these together, insurance penetration should be better than what is in the market as approximately 1.1%. And that is really where we are going.
And you're still watching Business Live. We're taking a short break. We'll be right back with more business stories this day. Hello and welcome. Now, a cashew trade and exporters company in the Bono region says the inability of farmers to dry the cashew seeds will affect its quality and pricing. The field manager of the Red River Foods Ghana, Senor Joseph, attributes the situation to competition that leads to the selling of wet cashew nuts. At a stakeholders forum by the Brekum West Department of Food and Agriculture at Jinijini in the Bono region to educate farmers on the production of quality cashew nuts, Senor Joseph says that the Tree Crop Development Authority must regulate buying of the cashew seeds to ensure the quality of the nuts and premium pricing.
In the case of cashew, the industry is so complicated, and the type of competition is making people move after farmers. So once farmers are being chased to sell their product, they also find it difficult to sell the product dry. So they end up selling it wet. But what it means is that in the beginning, farmers feel like they are making profit because they are selling the wet product. But at the end of the day, because the quality depreciates very quickly, it affects the nut and the quality that we are getting from Ghana. And that's one of the things why the price keeps fluctuating. When you have a 50 lbs quality in, let's say, May or June, you will be able to sell it at a higher price as compared to a 40 lbs or 45. Cashew is being procured based on quality, and if you have a very good quality, then you stand the chance of earning a premium price. I will not push the blame to farmers, because if all buyers are looking for dry cashew nut, then they will be compelled to dry it before they sell. So we are calling on the Trade Crop Development Authority to come out with regulations that will also allow buying companies and agents to make sure they are buying something which is only dry. Just like in cocoa, you cannot go and buy wet cocoa beans from a farmer because the industry is being regulated. And these are some of the things we are actually looking after. The price of cashew to most people is not stable. And these are some of the things we think should be worked on.
Well, we shall be keeping an eye on the matter regarding cashew, because we do know that the Ghana Export Promotion Authority has placed cashew as one of its leading, non-export products in 2025. We're talking of an excess of 5 million Ghana cedis by that particular moment. Already, we do know that the main challenges faced the cashew industry has to do with its value chains, from post-production losses to issues regarding the climate and even government financing. As we speak, several cashew farmers across the northern zone say one main challenge they are faced with isn't that of even climate change, but the lack of access to finance. What happens is that when they get most of these cashew crop and they process them, they are not in that particular position to market their products to market in Accra and even beyond the shores of Ghana. Why? Because they do not have the adequate funding resources to make this happen. As we speak as well, Kenya, Nigeria, and South Africa are the leading exporters of this crop, even though when it comes to quantity, Ghana is doing much more in production, over 200,000 cartons of cashew each and every year. The question remains, what happens to the value chain and what happens to the export potential of this particular cashew crop? Already, we have engaged the Ghana Export Promotion Authority, and they are saying that this remains a huge challenge for them as well, even though they've established specific development partnerships with, that of the German GIZ and the USAID to aid in the facilitation of this cash crop. But we shall be keeping an eye on this to give you updates as and when we do have them. Aside from that, costs of iron rods have gone up by 50%, and building contractors are also complaining about the low quality of these iron rods. Nana Kwame Hayford is a project engineer at Cass Valley Properties at Oyibi in the Greater Accra region and has been speaking to Odelia and Tiamwa on the show Brick and Mortar.
Yes, prices of material has recently gone up, and it's so astronomical that people are finding it difficult to continue their project, especially when we take the iron rod, for instance. In a span of 3 months, from November to now, it's close to 50%. And it has made a lot of people in the construction industry are set aback as to whether to continue their project or to hold on. If the prices will come down, then they continue.
Run us through from November.
Yes.
What was the cost of iron rods in November per ton?
Yes.
And as of now, what's the price?
Yes. In November, a ton was going for 3,500 cedis. Mm-hmm. And now, as we speak, it's 5,200 cedis, which is representing a price difference of close to 50%.
Yes.
That's 1,700 thereabout.
Yes.
And it's making people who use, we are more into conventional kinds of building, which use the blocks, the cement, the iron rods and all that. So it's difficult really controlling. So it has made some of the real estate people even a big problem for them to continue constructing for their clients. And some that are doing that are doing it reducing their gains. That because once you've signed a contract with somebody to build, it means that if it's gone up, he or she has already committed. So it means that you, the company, would have to find ways and means to go.
Yeah.
And the disadvantage of this is that if you don't have a credible construction company, they will start cutting corners to still have the appreciable gains to the detriment of the client.
And you may want to catch the show this Saturday on Joy Prime channel at 4 p.m. on the prompt. Well, that's how we wrap up this edition of Business Live for the week. My name is Charles. It's a pleasure having you with us. From me and the entire team, many thanks for watching.